Welcome to the Vaughan Nelson podcast. With me today is CEO and CIO Chris Wallis. Welcome, Chris.
It's great to be here, Dan.
Well, Chris, it finally happened. Since the last time we were here, we got a rate cut. And have you seen anything happen? Has there been any impact on the market that you can measure?
Um, you know, Not surprisingly, the Fed follows the market. So since the the announced rate cut by the Fed, we've actually seen rates, somewhat flat to maybe higher. I think when you really step back, as we've always said, the Fed follows the market. The market has known that we were going to start to cut short rates. And if you actually look at the Treasury curve from the 3 year out to longer durations, interest rates actually have moved higher over the last 6 to 12 months and not lower. So we've steepened the curve. The short end has come in from the 3 year and beyond. It's actually moved higher. So while we've seen some decline in mortgage rates modestly, we've probably seen some decline in other borrowing rates. The biggest impact has been on the shortest end. So think lines of credit, maybe potentially a home equity line of credit. But mortgage rates are still over 6%, six and a quarter. And most of the decline we've seen anywhere off the Treasury curve is because of spread compression, meaning, the amount of excess return that investors are demanding for any risk has declined. And as a result, I don't know that we should expect significantly lower rates from here. I do think the Fed needs to cut rates several more times, probably more than what they're admitting to right now. But as we've talked about, I don't know that that means lower rates further out the curve. You need to think about the US market more as an emerging market as it relates to funding its deficits. So rate cuts because of weak economic growth means higher deficits, pressure on the long end. Rate cuts into what we are now, which is improving and increasing inflationary pressures and improving growth means higher rates on the long end. It's going to be really difficult to get rates materially lower without some form of yield curve control or other heavier policy action.
And also, we've seen a fairly broad market rally that's taken place and we're in the midst of. And anything that we can point at that's behind the move? Do you think it's sustainable? Do you think we'll finally maybe experience a bit of a change in leadership?
Yeah, look, the market the rally in the market's been broadening ever since it bottomed in early, I guess that was Q2. Part of that is just the market coming to grips with all the policy announcements and realizing a lot of the tariffs that were announced are never going to get implemented, or even if they are implemented, they're really not material. We don't have to worry. We're not going, as we've said all year, we're not going into a recession. There is no pending recession. If anything, the private sector has been much weaker over the prior 12 months. It's been federal spending that's been supporting activity and a pull forward in demand ahead of tariffs. And now we've bottomed out inventories so the private sector can start to improve from here. And after maybe a couple more months of softness in employment, we'll start to get some improvement in employment. And so the market, is just embracing risk again because it's kind of wrestled with those more policy-oriented issues and is moving past them. But the other element, and you just go back and look, we saw a big shift in performance in small caps and micro caps and cyclicals in general beginning August 12th. And that was the day after the US CPI print. And the CPI print showed an increase in inflation. We're going to see another increase in inflation when we get the September numbers. And although it increased, it's modest, it's manageable. There wasn't a big surge. And so any other concerns regarding inflation as it relates to tariff or policy, the market was able to put that behind them. And the most important element is investors were entirely too bearish and their positioning reflected that. And now they've been caught off sides. And so the market is being led by high short interest stocks, by loss makers, by long duration, by companies with impaired balance sheets. And this is very similar to what we saw in early 21, late 2020 when we got the vaccine and everybody was nervous and everybody was bearish. and it was a lot of forced short covering. So I think what we've seen is repositioning. So I don't think the leadership in the most distressed balance sheets and the high short interest is sustainable. I do think we're going to continue to see this broadening of market participation. The AI trades worked really well. From a rate of change standpoint, it's going to get a little long in the tooth. B, this short covering is going to cause people to go look in other areas. And so the money that may be leaving or gains that are being harvested out of the large cap tech area are going to go other places. And it's going to be supported by improving growth. I expect inflation to tick up over 3% over the next couple of months, and then it's going to peak and liable to start rolling over in the first half of 2026. Growth is going to get incrementally better with each quarter from now through the first half of 2026. You put those two elements together, it's incrementally more constructive, which is why we've seen the market rally the way it has. So a broadening, a repositioning, the worst of the balance sheets aren't going to lead us out of here, but it does mean broader participation and maybe less narrow leadership out of large cap tech.
Good. Something we could all see. So, all right, good. Well, that's a good place to stop for today. So thank you very much, Chris, and we'll see you soon.
Sounds good.
The views, information, and/or opinions expressed during this podcast are solely those of the individuals involved and do not necessarily represent those of Vaughan Nelson and its employees. Vaughan Nelson does not verify and assumes no responsibility for the accuracy of any of the information contained in the podcast. The primary purpose of the information, opinions, and thoughts presented in this podcast is to educate and inform. This podcast, or any podcast in the series, does not constitute professional investment advice or services, and any reliance on the information provided is done at your own risk. Past performance is not an indication of future performance. By accessing this podcast, you acknowledge that the entire contents of this podcast are the property of Vaughan Nelson or used by Vaughan Nelson with permission and are protected under U.S. copyright and trademark laws. Securities discussed within this podcast may be held in the Vaughan Nelson strategies.